When cryptocurrency markets are soaring, holding Bitcoin feels easy. Prices are rising, optimism is everywhere, and every day seems to bring new predictions about how much higher the market can go. But the real test of an investor isn't what they do during a bull market, it's what they do when everything starts falling apart. Market crashes can erase years of gains in a matter of months, triggering fear, panic, and emotional decisions that often do more damage than the crash itself. That's exactly what happened when Bitcoin entered a major downturn. Today, we will talk about holding Bitcoin through the crash years, what the portfolio looks like now. So before we get started, make sure to hit that like button, also subscribe to my channel. 10. The first days of the crash were pure emotion. When the market first began falling, logic quickly disappeared and emotions took over. Seeing a portfolio lose thousands of dollars within days or weeks can create a feeling that is difficult to describe. Every news article seemed to predict more losses. Social media was filled with fear, criticism, and stories from people who were selling everything before it became worse. The biggest temptation was to press the sell button and escape the stress. This is the moment where many investors make their most expensive mistake. They make permanent decisions based on temporary emotions. The investor who held Bitcoin realized that a strategy built during good times means nothing if it disappears during bad times. 9. The portfolio value dropped. But the Bitcoin amount stayed the same. One of the biggest psychological lessons during the crash was understanding the difference between price and ownership. The dollar value of the portfolio was falling rapidly, which created the feeling of losing everything. However, the number of Bitcoin owned did not change. If the investor owned 1 Bitcoin before the crash, they still owned 1 Bitcoin after a 50% price decline. This shift in thinking helped separate short-term market movements from the long-term investment thesis. A lower market price did not automatically mean the original reasons for investing had disappeared, although the investment remained risky and uncertain. 8. The biggest mistake would have been investing money needed soon to crash revealed an important rule of investing. Never put essential money into highly volatile assets. Investors who used money needed for rent, emergency expenses, debt payments, or short-term obligations often had no choice but to sell when prices were low. This transformed temporary market declines into permanent losses. The investors who survived the crash were often the ones who had emergency savings, diversified finances, and a long-term time horizon. They had prepared themselves financially before entering a market capable of extreme movements. 7. Market noise became the greatest enemy during the crash. Everyone had an opinion. Some people claimed Bitcoin was finished forever, while others promised that a massive recovery was just around the corner. The reality was that nobody knew exactly what would happen next. Watching endless predictions created confusion and emotional stress. The investor learned that constantly following every headline, social media argument, and price prediction made it harder to make rational decisions. Instead, they returned to their original investment plan and evaluated whether their reasons for holding had genuinely changed. 6. The portfolio was reviewed. Not abandoned. Holding through a crash did not mean ignoring reality or refusing to think critically. The investor reviewed their portfolio, risk exposure, and financial goals. They asked difficult questions. Was the investment size still appropriate? Could they handle further losses? Did the investment still fit their long-term strategy? Successful investing is not about blind loyalty to an asset. It is about making thoughtful decisions based on changing information while avoiding emotional reactions caused by fear. 5. The crash became a lesson in patience before experiencing a major market decline. Many people believe they are long-term investors, but a falling portfolio reveals the difference between saying you are patient and actually being patient. When prices were increasing, holding Bitcoin felt easy. When prices were collapsing and everyone was predicting disaster, patience became extremely difficult. The investor discovered that long-term investing is not simply about waiting during good times. It is about maintaining discipline when uncertainty reaches its highest point. 4. Continuing to buy during the downturn changed the average cost. Some investors choose to continue investing during market declines using a strategy called dollar cost averaging, where they invest fixed amounts regularly regardless of price. During the crash, continuing to buy meant acquiring more Bitcoin at lower prices, which could reduce the average purchase cost over time. This strategy does not guarantee profits or protect against losses, especially if prices continue falling. But it allowed the investor to follow a consistent plan instead of reacting to fear. The focus shifted from trying to predict the bottom of the market to building a position gradually over time. 3. The recovery looked different than expected. Many people imagine that after a market crash, recovery happens quickly and smoothly. In reality, recoveries can take time and often involve periods of optimism followed by more uncertainty. There were moments when the portfolio started growing again, only to experience another decline. The emotional journey was not a straight path from fear to success. It required accepting uncertainty and understanding that markets rarely move exactly how investors expect. 2. The biggest return was not only financial, when the portfolio eventually stabilized or recovered. The most valuable gain was not only the change in dollar value. The investor had developed skills that could not be seen in a portfolio balance. They learned emotional control, patience, risk management, and the importance of having a plan. They understood how dangerous fear and greed could be. These lessons became valuable not only for cryptocurrency, but for every future financial decision. 1. The portfolio changed, but the investor changed more. The most surprising part of holding Bitcoin through a crash was realizing that the greatest transformation happened mentally. Before the crash, the investor focused mainly on profits and market excitement. After surviving a severe decline, they understood the true meaning of long-term investing. They learned that volatility is the price many investors accept in pursuit of potentially higher returns. But there are no guarantees. They became more focused on strategy, proper risk management, diversification, and making decisions based on logic rather than emotions. The portfolio's numbers may have eventually improved, but the ability to remain calm during uncertainty was the lesson that changed everything. Holding Bitcoin through a major crash is one of the hardest experiences an investor can face. Watching a portfolio lose a large percentage of its value tests confidence, patience, and emotional control. Some investors panic and sell at the worst possible moment, while others choose to stay invested because their long-term strategy and risk tolerance allow them to do so. The outcome can vary greatly depending on future market performance, entry prices, and individual circumstances. The biggest lesson from this journey is that successful investing is not only about buying the right asset at the right time. It is about having the discipline to follow a thoughtful strategy when the market becomes unpredictable. It means managing risk, avoiding investments that could damage your financial security, and understanding that every investment comes with uncertainty. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.